look at this exercise together. In this exercise, they give us a series of transactions, and what we are ultimately going to do is compute the difference between the book balance and the actual amount of inventory based on physical count. Now, I'm pointing this out in terms of what's actually required because sometimes in problems they give you extra information, and they do in this problem. Okay, so let's look at event 1. Started the business when it acquired $74,000 cash from the issuance of common stock. That transaction will not affect inventory. Therefore, for the purposes of this particular exercise, we can just disregard event 1 because it does not affect inventory. Okay, in event 2, they tell us that we paid $31,000 cash to purchase inventory. Event 3, they sell inventory, which cost $17,900. They sell this for $36,000 in cash. That is the selling price. The $36,000 is the selling price. The $17,900 represents what the company paid for it. And then in event 4, they tell us that we physically counted inventory, which showed that $12,700 of inventory was on hand at the end of the accounting period. Now, before we get into the details of this calculation, let's talk about why it's important to physically count our inventory. Physically counting inventory is just a simple internal control that companies can implement to try to safeguard their inventory. Unfortunately, sometimes the actual inventory balance that you count that is actually on hand is going to be different from what the books show. There's a variety of reasons. Sometimes it could be due to maybe some inventory was damaged, or maybe some inventory was obsolete and had to be thrown out, or maybe theft. That can be sometimes that's called shrinkage. That can be an issue in companies as well. So let's look at how we are going to determine the difference between the book balance and the actual balance. Well, first, we're going to start with the amount of inventory that we purchased from event 2. In this case, it was $31,000. You can take whatever amount you have there, and that is going to be your purchased inventory. Then we're going to subtract out the cost of the inventory sold that they gave us up here in event 3. We're going to subtract that out. Based on this, we should have a balance of $13,100 left in inventory. However, when we go to the warehouse and we actually count the inventory, there's only $12,700 left. So the difference between the book balance of $13,100 and the actual count of $12,700 is $400. So basically $400 has disappeared or been unaccounted for. And you'll learn later on in your studies how to make an adjusting entry to report that difference. But for right now, we're just computing the difference. So it's a $400 difference in book and actual inventory.